This is practice 1 in chapter 5 that is working with adjusting entries. At the end of the fiscal period, there are some accounts that need to be adjusted. For instance, supplies is one of those that you have a supplies balance and you just keep adding to it every time you buy supplies during the month. Then at the end of the fiscal period, you do an inventory count and determine how many supplies you have left, and you have to adjust that account to show the expense during that fiscal period. Again, it's that concept, matching expenses with revenue during the fiscal period that you earned that revenue. So in this case, on December 31st, the trial balance shows prior to the adjusting entry $299. So we'll put TB, and that's $299 debit on the debit side of the T account. And then we're going to adjust it. A physical count shows that our supplies inventory, that $97 of supplies remains. So what we need to do is subtract that $299 minus the $97 that remains, and that means that we've used up $202 worth. So we adjust that $202 so that the balance is $97, which was our physical inventory account. And then we would also debit supplies expense. So the adjusting entry is a debit to supplies expense for that fiscal period for $202 and a credit to supplies to subtract it out of there. Okay, then we'd want to put that in the journal. So we would debit supplies expense. You can start typing it and it should pop up. And it was $202. And then we're going to credit our supplies account for $202. We planned it in the T account above, and now we are actually putting it in the journal. So check your work. That should be accurate. All check marks. So we move on to number 2. Another account that we need to adjust is prepaid insurance. We pay insurance in most cases 6 months at a time. So we are issued a 6-month policy, and so each month that we earn revenue, we have to subtract out 1 month of that 6-month policy. So this one says on December 1st, a 6-month liability policy was purchased for $1,056. So our trial balance is $1,056 to that asset prepaid insurance, which is why it's on the debit side. So what I'm going to do is calculate 6 months. So I do 1056 divided by 6. So each of those 6 months I'd need to subtract 176 out of insurance. So I'm going to do an adjustment of 176, which will give me a balance of 1056 minus 176. And again, what I did to find the 176 was divided that 6-month policy into 6. So 1056 divided by 6 equals 176 adjustment for every month. And I would debit insurance expense, because for every entry we do need to have a debit and credit that equals. So we're showing our expense for that fiscal period by doing an adjusting entry, and we're crediting it out of prepaid insurance, so our asset shows and reflects a current balance. Then we would go down here and put it in the journal, which is the official accounting form, insurance expense. Select insurance expense for $176 and credit prepaid insurance for $176. And then check your work. Okay, and my work was accurate, so I'll go on to number 3. Another item that we have to adjust sometimes is a wages payable. Occasionally, an employee may earn wages during a fiscal period, but it's not yet paid yet. This is called an accrual, a system of accounting. So because they earned it during that fiscal period, even though we haven't paid it, we still need to show those earnings to match with that revenue, that expense. So we're going to start with, on December 31st, the trial balance amount for wages expense was $1,095. An additional $365 of wages was earned but not yet paid, and we found that isn't, so we adjusted it for $365. And then, because both of those are debits, we do need to calculate a balance, and those are debits, so we're going to add it to our total cost of wages expense for that fiscal period. And normally we would pay cash for our wages, but because they've earned it but we haven't paid it yet, then we have to credit wages payable because we still owe that money. So we're going to credit wages payable for $365 instead of cash. And again, this is called an accrual system of accounting. So we debit wages expense for $365, and we credit the payable. And then once we've paid it, of course, we would debit payable and credit cash for having paid it. This happens occasionally when you've got a pay period that falls over from one month to the next, especially if you've got someone working under contract. End of this video.